Hello, guys. So you are welcome to another session where we look at the methods of strategic development. So after every time we get to a new session, I tell you to write the section overview down. This will help you in revision. So we look at growth through internal development. We look at the Greener's growth model. We look at mergers and acquisitions, diversification and integration, forward and backward integration, and product portfolio management. These are all methods that companies use to grow. So the thing is, whatever product and market strategies that you select, you must decide how to develop those chosen strategies. So there are three main approaches to developing a product market strategy for growth, right? Whether you want to go with internal growth or you want to go with what? External growth. So the whole thing is that if you are looking at this in broader context, when you are looking at what? Methods of development, okay? When you want to develop as a company, we are saying that, oh, you have two main ways, okay? You have internal methods, okay, or what we call internal development, and you have what we call external methods or external development, right? Now, internal method is what we call organic growth, where you grow with your own resources, right? And external development can be further broken into two. It could be where you go with mergers and acquisitions, or where you go with what joint development, right? Where you do joint ventures and strategic alliances. Okay, we have talked about joint ventures and strategic alliances when we're looking at collaboration. Okay, so remember this, and these are the methods of development that you mostly look at. So we are going to in turn look at them one after the other. So let's look at growth through internal development. Now, an entity might grow its business with its own resources, seeking to increase sales and profits each year. So there are several advantages of internal development over other forms of strategy for growth. Okay, so management can control the rate of growth more easily because they are using their own resources, right? And these are the advantages of internal development over other strategies for growth. Now, this is always highly likely. So if you look at your ICA exam or the past questions, you realize that most of the time, most questions, especially when it has to do with selection of a strategy, okay, they like to bring this a lot, where you look at how you are going to support that strategy you are choosing. Are you going to grow with your own resources, right? Are you going to grow with mergers and acquisition or joint development? So you are going to just answer the question using the pros and cons. So mostly, I told you when you are answering strategic choice questions, you are either going to add answer with pros or you are going to use cons. And then the next is you can use SFA to answer it, okay? And then there's a rare case where they ask you for the financial, operational, and then maybe the external impacts of you choosing any of them, right? So it depends. So when they ask you for the financial side, where you have to choose between internal development and then joint development, or maybe mergers and acquisition, you look at the financial statement of the company, and then you look at the company, the potential company that you want to go and acquire. Calculate some ratios, right? If the target company's ratios are suitable, or you see they have significant profits, especially ROCE, if you have information, you can calculate something like residual income to see the nature of that that particular company, whether he has a suitable financial return for you to acquire, or whether you can exchange shares with that company. So you look at all things, maybe you look at the proposal they give, and then you tell, oh, looking at this ratio, the company has sufficient capital to acquire this company, or this company does not have good reserves, so we shouldn't acquire the company. So it's up to you, right? But always when you're looking at the financial side, these are the things. And also from the operational side, look at the nature of the target company that you are going to acquire. Remember, even when you are considering mergers and acquisition, you are considering acquisitions. Remember the corporate parenting matrix, right? The corporate parenting matrix, or the Ashridge portfolio display, right? So also check whether the entity you are trying to acquire, you look at the field, okay, and you look at the benefit. First, does that entity you are trying to acquire meet your competencies and skills that you possess? Because if they're in line with your skills, you can work in harmony, right? You can work and create synergies. Then you look at the benefit, whether that entity needs your help, right? Or he's on its own, he's already his own boss. Do you have is there opportunities that you can create for that entity to create value, right? And we said that creating value, there are various strategies a parent company can use to create value when it acquires, right? You can use envisioning, you can use provision of services, okay? You can use things like coaching, okay? You can use things like what? Intervention, okay? There are a lot of ways the parent can provide value to the subsidiary. So you see how these things link together. So when you want to look at external growth, or you want to look at something like mergers and acquisition, you don't think alone, you don't just think idle, like, oh, okay, these are the advantages and disadvantages. Also talk about this, right? Using the Astrid portfolio display. We know that that is a 2x2 matrix that mixes what? The field, which is the competences, and then the skills, meaning you work literally in the same industry, then the benefit, which is whether you can provide value or opportunities to that benefit. And we know that you will get different sort of subsidiaries. You can get a ballast business, okay? You can get what? A heartland business. You can get an alien trap, an alien business, and trap business, or what we call a value trap business, right? So know all these entities, which ones have high field, low benefit, low field, high benefit, low field, low benefit, okay, and all that. So you have to check all these ones. Once you are able to check all these ones, then you take it from there. I hope that is well understood. So the whole thing is that when you decide to select so that is the rules you have to look at, right? You use these models together and you realize that you get so many things to talk about, right? And so these are the rules that you must understand when it comes to growth through what? Mergers and acquisition, especially when you have to look at the financial implications, operational implications, or even if that entity is in a different industry overall, right? Know what to say. So when we are looking at growth through internal development or organic growth, there are several advantages, okay, over other forms. So one, management can control the rate of growth more easily, as we said earlier, because you are growing on your own, and ensure that the entity has sufficient resources to grow what? Successfully. So the entity might not have sufficient resources to meet the growing sales demand. However, it will only make and sell as much as it can, efficiently and effectively, with the resources at its disposal. Also, the entity should be able to focus on its core competence and develop these in order to grow what? Successfully, because you are growing on your own. You are not using anybody else's resources to grow. Now, if the entity finds that it is short of key labor skill, it can buy the labor skills it needs by recruiting new staff, right? And that's how you grow. And also, there are no culture clashes because it is your own staff that you are using, and it creates a lot of motivation for staff because you end up promoting a lot of people, changing people, I get to giving people more salary or reward. Okay, so growing through internal development also creates a lot of learning experience because you are growing with your own staff, your own resources. You will be challenged to become a learning organization. You will learn more, right? So what are the disadvantages? For me, the first thing I will talk about for internal development is it's expensive, okay? It's expensive because for things like mergers and acquisition, you can decide to finance it by what? Share exchange. This one you cannot. You must have adequate cash to pursue an internal development strategy. So let me tell you something. When you are doing this, assuming they tell you that, oh, the company wants to pursue M&A or it wants to pursue organic growth, and you are looking at it, right? For instance, I can do a cash position analysis, right? So check the cash position of the entity. Okay, so if you have 20x2 and you have 20x1, and cash was what? 5 million this year, and last year cash was 1 million, and maybe the particular investment requirement for this acquisition, maybe the initial investment for the acquisition is somewhere around maybe 3 million, right? To take up this acquisition, and it may involve an outright cash or whatever, or maybe an investment, right? You want to pursue an investment with your own resources, and the initial investment is 3 million, okay? So if I'm doing a cash position analysis, cash position is just growth in cash, right? You are just checking the cash position of the organization. So what you can do is that we know that this is new minus what? Old, all over old. times 100, right? And that's what we can do, or new over old, or minus 1. So we can take our 5 million minus our 1 million all over what? 1 million, just to check by how much cash is growing. So we could say that in absolute terms, cash is growing by about 4 million from last year to this year. And in relative terms, cash has grown by about 400%. Okay, or has grown by about 4 times. So if you want to just leave it like that, it will be 4. If you want to use it in percentage, cash has grown about 400%, and the initial investment required is only about 3 million. And we have 4 million. That means we can pursue this strategy. But assuming cash decreased, or we didn't have enough cash, or cash was less than the required investment, and that means we can pursue a merger and or acquisition strategy where we can let the other company, the target company we are trying to acquire, we can't pay the whole 3 million to acquire him, right? So maybe we can do share exchange of some sort, right? So these are some of the things that you normally look at. Mostly, ICO always require you under strategic case study to compute ratios when you are dealing with this. But one thing I told you is that what organic growth or internal development is mostly very expensive. Okay, remember, organic growth is mostly very, very expensive. Okay, because you have to buy new, you have to promote stuff, you have to pay salaries, right? And all sort of things. Now, let's look at the biggest disadvantage of organic growth. It's probably that there's a limit to the rate of growth a business entity can achieve with its own resources. Yes, of course, we need more money. So rival firms might be able to grow much more quickly by means of mergers and acquisitions and what? Joint ventures. Now, in order to expand the business beyond the limits of its current capacity, it is necessary to invest in new capacity. So for a production company, this means investing in new production facilities. So the lead time between taking a decision to invest and the opening date for the new production facilities, possibly in another country, can be long. So until the new production facilities are open, the entity may be unable to meet customer demand. You see, this is a problem because as you have not done it yet, maybe you've gone for a place, you've leased it, you are now about to move, and all these things can what? Waste your time until the actual product is ready. And that time, customers may also be waiting for you because you are now trying to change. Maybe one part of the building is broken, it has to be settled first and all this, right? And this one, when this happens, you might lose business to competitors, okay? So this one normally happens if businesses do not plan appropriately, right? You are growing, you need to modify a bit of your store and all that, right? So after new production facilities are open, production capacity will probably exceed demand. And for a time until demand grows further, there will be some unused capacity and idle resources later on, right? Because until your demand changes, you would have unused capacity because you have expanded. Now, if there's an element of diversification, then internal growth presents some risks because the organization will have to learn new skills. So mistakes are almost what? Inevitable. Another disadvantage is that even with internal growth, the entity will eventually need to change its organization and management structures in order to handle the growth in its business. So unless an organization does not change, it will become inefficient. So unfortunately, introducing change to the organization structure and management style is by no means simple and easy to accomplish. People resist the change. There will be so much change blocks, right? So if you are growing with your own resources, there are some stages that you normally go through. And Greener's growth model provides an analysis of how organization and management structures might need to change as the business grows. So you see, they are even telling you when you require the model. Are you getting it? So when you decide to grow on your own, how your organization management structures, are you getting it? And the organization itself might need to change as they grow is stated. And this one can also be appropriate for what? The most suitable organization structure, right? The most suitable what? Organizational what? Structure. So if you go to the exam, Greener's growth model can be examined from 2 different perspectives. It can be examined from whether how the business needs to grow, when it needs to grow organically, okay, with its own resources, or what organizational structure should be chosen at a particular point of growth, right? At a particular stage in the growth cycle of a company. Are we okay? So that is how it is. So let's see. in the 1970s, Greener suggested that an entity that grows in size goes through a series of changes as it gets bigger. Now, each change occurs in response to a crisis, when the existing organization and management structure is no longer capable of handling a business as large as it has now become. So according to Greener, there are 5 phases in the life of an entity, okay? So these phases and the crises that start each new phase are set out in the diagram below. So in your earlier years, when you've not grown, you are just small, right? Where you are just starting out, that is the period where we have the entrepreneur starting out, right? So at that point, you are creative, you go through creativity, where it's just the boss and his staff, right? So at this stage, there's the issue or the crisis of leadership, right? Because everybody's under one boss. Now, when you go forward, you would want to give a direction to the company, right? This is where you have growth through what? Direction. And this, you set up functional structures, right? And now, when you set up functional structures, you realize that still there's no autonomy, right? There's nothing like division. So you see that it starts with the entrepreneurial structure. It goes to where you have what? The functional department. Let's say there's the CEO, then there are various departments under him. So the crisis of autonomy, you are not making them autonomous. Then you now go through growth through delegation, where you now have to delegate, right? You have to delegate authority because you are facing the crisis of autonomy. So now you what? You delegate to people. And then from there, the crisis you are going to face is that now you don't have control when people have been delegated, right? So you now create a lot of bureaucracy. And that is where you now try to coordinate activities between the various divisions. Now, you creating or coordinating activities among these divisions will create a lot of red tapes, right? If you want to see somebody, you have to meet this, meet that, and that creates what? A crisis of red tape. Then we have growth through collaboration, which comes with its own crisis, right? It depends on the type of collaboration. So you see, there's peaks and troughs happening, right? In the oscillation, always at the end. Now, let's look at the phase 1, which is the period of growth through creativity. Now, the early years of a successful business entity are a period of creativity and innovation. So the entity is probably managed in an entrepreneurial way, and it is producing new products that appeal to customers and is developing new markets. So over time, production becomes more organized as the entity grows. The entrepreneurial method of management and the existing organization structure both become inefficient, right? The organization needs organization and planning and control systems. And there is therefore a crisis of leadership, okay? So management must become more professional. The entity therefore introduces professional management and it enters its next phase of growth. So because you face the crisis of leadership, you have to now organize well, right? And now direct. So the entity is now more structured because we are trying to solve the crisis of leadership, right? With a traditional management hierarchy. So formal systems are now introduced, such as planning and control systems, budgeting and budgetary control, accounting systems, inventory control, production scheduling, communication, and IT systems, right? However, as the entity grows, the hierarchical management structure, which is the functional structure, becomes inefficient. So before, when you started with growth through creativity, your structure would have been like this. There's the boss, right? There's just the boss here and the staff under, right? All the staff. These are all staff, staff 1, staff 2, staff 3, staff 4. Now, as you solve the crisis of leadership, and then now you have a lot of staff, you have control systems, you have planning systems. Now it's going to be what? The boss being here, right? And then you have what? Department, right? So we have various functions. Maybe we have R&D, we have finance, we have HR, we have maybe marketing, right? And each of them now have what? A lot of staff under them, a lot of staff under them. But we are saying that this hierarchical structure, which we know, right? As the entity grows, it becomes inefficient because now there are so many jobs that needs to be done, right? So what happens is that the control system and the reporting systems are designed initially for close control from the top by senior management. But however, management control from the top is not as effective as it used to be, right? Because now there are various channels for which you have to transfer, right? And there's no autonomy. So top management are far away from actual operations, and local managers know much more about how the business functions in the area of operations. That's why we face the crisis of autonomy, because we haven't given autonomy to those we have delegated, like the R&D, man knows what is happening down there, and the people at the top, they don't know. The board of directors do not know what is going on, right? So there's a need to make these people autonomous. So the tensions between senior management and local management grow until local managers are given more authority to take decisions for themselves. The entity will be managed inefficiently from the top, right? Because you don't know what is going on. You might think these people need good drinking water. Meanwhile, they don't need water. They need good roads, right? But the managers down there know what is happening. The supervisors, the foremen, the functional heads, they know what is going on down there. Now, after you try to solve, when you try to solve the crisis of autonomy, you go into a period of growth through delegation. So in order to survive, the entity is reorganized with much more authority delegated to the local managers. Now, the entity is organized in divisions, right? Which might be profit centers. So a profit center is what? A segment of a business where a manager has the responsibility of accumulating both costs and revenues, right? So let's take the marketing department. In the marketing department, you see, we do market research, which is cost. We also take sales, right, which is money. So that is a profit center, a segment where a manager has a specific role. Now, central management receives reports from the divisions, but divisional managers take most of the decisions about how the division should be run. So central management concentrate much more on strategy and business expansion. So you realize that here, the most appropriate structure is the divisional structure. So we started in creativity. We went through what? The entrepreneurial structure, the simple structure, came to period of what? Direction, growth through direction. And then we came to look at the functional structure. Because of autonomy, there was no autonomy. Now we gave them what? Autonomy. And now we have what? Growth through what? Delegation. Okay. So you realize that as you now what? Make more decisions from the divisional level, the entity will continue to grow. But as it grows, central management will now realize that they are losing most of their own authority because the local managers know more. And that the local managers are becoming too powerful and unaccountable. You cannot control them now, right? So it creates a crisis of control. Now, central or senior management must change the organization and management structure to avoid losing control. And this leads the entity into its next phase of development, which is a period of growth through coordination. Now, what is period of growth through coordination? In this phase, central management monitors the local managers carefully using sophisticated reporting systems. So local managers are more accountable, although they have delegated authority to make decisions, right? So the focus is now on coordinating the activities of all the different local operating divisions within the entity and also consolidating the business. So something that may work here is that, yes, you might have what? A geographical structure in place. You might have a matrix structure in place, right? Because you want to coordinate activity. So one person can report to project manager and report to what? The departmental head, right? Just to ensure there's appropriate coordination. However, as the entity continues to grow, the reporting systems start to create a bureaucratic culture at the head office, right? As we said earlier. And local managers become angry at having to provide so many reports and explain so much to head office when they feel that their time would be better spent in managing the operations. So it leads to the crisis of red tape with too much form filling, report writing, and bureaucracy, okay? So with that, when you are trying to now solve the issue of red tape, you go into a period of growth through collaboration. So Greener suggested that the crisis of red tape leads to a further change. To overcome the problems of red tape, head office management and local managers find ways to collaborate more constructively. So there's a greater emphasis on teamwork and problem solving, and less emphasis on formal report systems and accountability. So participation in decision-making by more individuals is encouraged. So since no entity has gone beyond phase 5 of its development, Greener suggested that it was too early to tell whether there's a crisis the end of phase 5, leading crisis at the end of phase 5, leading to even more change. So that's why when we got to phase 5, I told you that it has its own crisis, right? Because you can't tell because you haven't got there. So for now, we don't know the crisis that will happen, right? That's what Greener actually said. So if entities continue to grow, they will have to go through the phases of transformation. If they do not, they'll become inefficient and will fail to survive, right? That means you cannot even get to phase 5 because there's so much crisis, right? For example, and when this happens, right, if you were trying to grow, you didn't grow well, you didn't structure well, it might create what? a problem, and you may become a takeover target because people may want to take over that company. So let's look at mergers and acquisitions, which is external development. Now, an entity can grow quickly by means of mergers or acquisitions, right? Now, both mergers and acquisitions involve the creation of a single entity from two separate entities. So with a merger, the two entities that come together are approximately the same size. So if it is two companies of the same size coming together, it's a merger. But with an acquisition, one entity is usually larger than the other and acquires ownership or control by purchasing a majority of the equity shares of the smaller one, which is the target, right? So we have the predator company and the target company or the prey. So acquisitions are more common than mergers, but large mergers are possibly more significant because they can create market leaders in their industry. Examples of large mergers have been pharmaceuticals like SmithKline, Beecham, and Glaxo to form GlaxoSmithKline. The merger of media giant Time Warner and AOL, the merger of consumer products manufacturers Procter & Gamble with Gillette. So what are the advantages of mergers and acquisitions? Acquisitions and mergers have what? Several advantages as a strategy for growth compared with what? Strategy of organic growth or internal development. Now, growth by acquisition or merger is much faster than growth through internal development. Yes, because now it's not going to take time. The person has the systems already. Why not acquire him? An acquisition enables an entity to enter new market where the barriers to entry are high, so that it will be very difficult, right, to set up a new business in competition when an old business is already there. If you can't beat them, you join them, right? So an acquisition prevents a competitor from making the acquisition instead, right? So you do it. It might result in cost savings and higher profits, which is synergy. The point is discussed in a more later detail, right? In detail later. Now, what are the disadvantages of acquisition and mergers? And I also forgot, it could be cheaper than an organic growth because we can do share exchange. Okay, so remember to add it. So what are the disadvantages of acquisitions and mergers? Now, an acquisition might be expensive as well, right? So the bid price has to be high enough to make the shareholders of the target company willing to sell their shares. You must give them something better, right? So the return on investment for the entity making the acquisition might therefore be very low, which is a disadvantage because it's expensive too. A merger acquisition can result in a loss of proportional ownership of the entity. It can lead to dilution of control. So for example, if two entities with an equal total value are merged together, the shareholder who held, say, 10% in one of the companies before the merger will now what? Have his control diluted. He may only own 5% of the merged company. The actual change in proportional ownership will depend on the structure of the merger or the acquisition and how you decide to finance it, whether by cash or shares, right? Which may what? Either affect what? The nature of your shares or create dilution in control. Now, the two entities will have different organizational structures, different management styles, different cultures, culture clash, right? Different systems of salaries and wages. Now, bringing them together into a single entity will be extremely difficult. So naturally, many employees will feel threatened, as often takeovers are followed by what? The company seeking cost efficiencies, including redundancies. So many good employees could leave. Generally, the period of disruption following a takeover or merger will last around a year. So when individuals from different cultures are brought together into a single organization, there will be probably a clash of cultures, right? And it may be difficult for individuals from different cultures to work together easily. So they will have a different outlook on business and will have different ideas about the way that work should get done. So the problems of a clash of cultures are particularly severe when companies merge or when one company takes over another. So there have been several well-publicized examples of culture clashes in the banking industry when a commercial bank, like a traditional lending bank, merges with an investment bank. So that was it about mergers and acquisitions, the advantages and disadvantages. But when it comes to mergers and acquisition, you must ask yourself, why the merger? Why are you going to do the merger? We often look at the main reason or the key reason for going into a merger or acquisition, and that reason is synergy. Now, synergy is often a key reason for a merger or acquisition, right? Synergy will occur when, as a result of a merger or acquisition, there are some operational or financial benefits. So, one, there might be overcapacity of equipment and property so that the surplus assets can be sold off, right? It might be possible to also make operational changes to save resources. In particular, an acquisition often results in redundancies for large numbers of employees. So running costs are also what? Reduced. So two research and development departments can be combined into just one, and savings in running costs could be possible. So there are different types of synergy. You can acquire finances at a lower cost because of the merged entity's power. You can have cost savings. You can have market share, right? So it could be a market synergy, it could be a cost synergy, it could be a financial synergy. Okay, it could even be a tax synergy, right? Which is an example of what cost saving, where we can save taxes. Okay. So, however, it has been found in practice that a very large proportion of acquisitions and mergers fail to achieve the expected synergy that they want. And the difficulties with bringing together two different organizations, management styles, management structures, and cultures mean that there is often a high risk of a loss in efficiency and higher operating costs. Okay, so let's look at acquisitions and the need for financial strength. Now, a successful strategy of growth through acquisition requires financial strength. Now, a company needs one or more of the following. One, a large amount of cash that is available for long-term investment. Some acquisitive companies have a war chest of cash that they use to buy target companies. And you must have access to additional funding in the form of new equity. So from new share issues or borrowing with bonds or loans, right? And highly regarded shares. Many acquisitions are negotiated as a share-for-share exchange, as I told you earlier, with shareholders in the target company agreeing to accept shares in the acquiring company as payment for their shares. To succeed with acquisitions financed by share-for-share exchange, a company's shares must be well regarded by investors so that shareholders in a target company are willing to accept shares as payment. Okay, so that was about mergers and acquisition. Now, you know, as part of mergers and acquisition, we have what? Mergers have integrations. Acquisitions and mergers have integrations, right? They are also part of expansion. They are types of expansion, right? So when you want to expand, remember that as part of diversification strategy, we have integration strategies, right? So let's look at diversification and risk. Now, diversification has already been described as a strategy for growth, and entities that grow by diversification usually do so by means of mergers or acquisitions, okay? That's how you diversify. It has also been stated that diversification is a high-risk growth strategy because the entity is moving into both new product areas and new markets at the same time, and it does not have experience in either. So conglomerate diversification is a greater risk than concentric diversification, and I hope you know what it is, because conglomerate is where you go into an unrelated industry, and concentric is where you go into a related industry. So with concentric, the entity is moving into related product market areas where it might be able to use its experience and core competences more effectively. So integration is a term that means extending a business, and integration is a form of diversification, right? So there are two main types of what integration. It might be what? A horizontal integration and a vertical integration. So if you go and they ask you types of mergers, you can use what? Horizontal integration and vertical integration to explain it. These are all types of mergers, right? Now, horizontal integration is where an entity extends its business by obtaining a larger share of its existing product markets, right? Typically, an entity might acquire one or more of its competitors. So horizontal integration works like this. You are at the same level, right? So where two entities at the same level acquire each other. But with vertical integration, it's like this. It means you're either going to the raw material base, right, to acquire your supplier, or you are coming forward to what? Acquire a customer or a distributor, right? So that is how it works with a vertical integration. So acquiring the same business in the same line of business at the same level is horizontal integration. So acquiring one or more of your competitors. And then with vertical integration, you extend your business by acquiring or merging with another entity at a different stage in the supply chain. So a strategy of vertical integration is usually a form of concentric diversification because you are still in that same related industry. Okay, so let's look at vertical integration, which can be broken into forward integration or backward integration. Now, with a forward vertical integration, also called the downstream integration, the name is very important because ICA can decide to examine you from the point of what? Downstream integration. Are we okay? So an entity enters product market of its customers. For example, right? A manufacturer of tires might go into the production of motor cars or motorcycles, right? A wholesaler who sells goods for resale to retailers might go into the business of retailing itself or acquire a retailer. An entity specializing in oil and gas exploration might move into the market for oil and gas extraction. So all these things are forward vertical integration. Then we have a backward integration or backward vertical integration, also called upstream integration. An entity enters into product market of its suppliers. For example, an entity specializing in oil and gas extraction might move into the market for oil and gas exploration. An entity operating a chain of cinemas might go into the market for film production. A shoe manufacturer might enter the market for leather production. So you are going back to the supply chain, right? So what are the arguments for vertical integration? If you are going into vertical integration, I think this question popped up 2 days ago, and I was shocked students could not answer this. Now, integration can give an entity a position of strength in the supply chain, particularly if it is a major competitor in the market. So the reasons given for forward or backward vertical integration might be as follows. One, backward integration gives you control over your source of supply. That's its advantage. And forward integration can give you control over your channels of distribution. Okay. Overall, vertical integration allows you to extend your expertise and skills into related product markets. And vertical integration makes it easier to find ways of reducing costs in the supply chain and also adding what? Value. Vertical integration can help to differentiate the product. So backward integration could aid designing and making unique components. Forward integration could also help to sell products in a unique environment. However, it might not be certain how customers or suppliers might react. For example, if a wholesaler goes into the business of retailing, will its other retailer customers stop buying its goods and switch to buying from a different wholesaler who is not also a competitor? Okay, so you look at other issues that might be created. In cases, you can discuss these issues, right? There's also a risk that integration might reduce the competitiveness of the entity. So what are the arguments against vertical integration? Now, avoiding discipline of the market, right? A cozy, relaxed relationship is likely to grow between, say, an in-house component manufacturer and the producer of the finished product, right? Because now we are working together. The component manufacturer knows that the group company will almost certainly buy its components. And so there's little pressure for cost efficiency and innovation because you feel like now we are in the same group, you have acquired me, right? So even if I don't put in so much effort, you are still going to buy my raw materials, which is a disadvantage, right? Other companies might turn out to be more successful than the one bought in by the group. For example, a rival component manufacturer makes a technical breakthrough so that their components are better and cheaper. It might be better on each purchasing occasion to have the pick of all manufacturers so that the best and most suitable cost-effective components can be bought. Now, different management skills may also be there, right, for these companies that you are bringing in. Now, if a manufacturer takes over a distribution chain, the skills needed to manage that will be quite different, and the company can easily mess things up. And also your core business, right? You should examine your value chain and your distinctive competencies, things that set you apart. It doesn't mean because you're in the same industry, you can work well. No, it doesn't happen like that. This must be protected. You must protect your core competence, right? And buying another company can mean that management pays less attention to the areas of its business that really matter. Now, the use of capital. So is buying or setting up a supplier or distributor really the best way for the company to use its capital? You have to ask yourself. So this is a capital investment decision you have to check, right? So let's look at some example for integration. Now, several companies that manufacture high quality goods have adopted a strategy of acquiring their own retail outlet to sell their products and to project sophisticated brand image. These companies include Louis Vuitton and then Apple, right? Another example is Nespresso, a subsidiary of Nestle. This company originally in '86 sold coffee capsules for espresso machines and then expanded its business into selling coffee machines that were manufactured by other companies but sold under an espresso brand name. More recently, the company has opened a small number of coffee boutiques in prestigious locations like Madison Avenue in New York and Beauchamp Place in London, right? Selling high-priced coffee in luxurious surroundings. Now, the aim of this strategic development, however, is not to sell more Nespresso coffee or become an upmarket chain for coffee shops. The concept is to make customers more aware of Nespresso coffee machines and to persuade more customers to buy the machine. Okay. So the next area of your growth is to look at product portfolio management, which we have discussed So we looked at the BCG matrix and other product portfolio matrices, right? So product portfolio management is another approach to developing a corporate growth strategy. So most companies sell a variety of products or services, which together make up their product portfolio. So resources are always limited. So companies should try to allocate available resources between the different products in the best way possible. So by managing products as a portfolio, companies are able to, one, allocate resources like finance in the optimal way between the different products. So priority can be given to the best value products in the portfolio. And you can identify areas also for potential improvement and balance the mix of products in the portfolio to ensure that the company optimizes profit. Now, strategic management of a product portfolio should mean that a company maintains a range of products at different stages in their life cycle. Well-established and profitable products, the cash cows, can provide finance to support products that are in the early stages of their development, like the problem child or the stars, okay, which are still in the growth stage. Now, and decisions can be taken about when to stop making some products when they move into their decline phase, right? So a balanced portfolio will contain both established products and products that will be tomorrow's winners. A balanced portfolio can be aligned with the company's strategic objectives and also its acceptable risks, okay? So developing strategies for the product portfolio as a whole also enables a company to review and revise the portfolio continually according to changes in market conditions, competitors' actions, and resource availability.